Hi, this is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in today's episode, I'd like to do a bit of a deep dive on Vanguard Super. So normally in this podcast, I like to talk about strategy and tactics rather than specific products or businesses. I want to really be careful to avoid sort of looking like I'm promoting particular products or trying to sell something or anything like that. My goal is to maintain absolute integrity and independence, and therefore this blog be regarded as a trustworthy source of information. And it's important to clarify that my business takes the same approach, of course. We've got no commercial interest in how our clients manage their money or spend their money or invest their money. We maintain complete independence and objectivity around something like that, and I want the blog to be the same. However, I'm going to make an exception for this episode because this episode is just about Vanguard Super. Now, I'll get into why that's important or why I thought that was important. But before I do that, let's talk a little bit just about Vanguard for those that might not be aware. I mean, they might recognize the brand name, but might not have a full understanding of its history, which is kind of important. It paints the picture. So it was founded by a guy called Jack Bogle, who has now subsequently passed away. And they launched the first indexed fund that was available to individual investors in 1975. Long time ago, actually the year after I was born. It was that long ago. Anyway, there was index funds before 1975, but they were only available to institutional investors. And Jack Bogle had this vision that he wanted to create an investment company that really prioritized the interests of individual investors rather than outside shareholders or managers. And as a result, Vanguard operates under a unique ownership structure. That is, it is owned by its funds, and the funds are owned by, so the managed funds or index funds or ETFs. All of those I will refer to as funds. And so it's owned by the funds and the investors own those funds. So ultimately it means that Vanguard is owned by its investors. It's a mutual entity, which means it's not a for-profit business. And as a result, any profit that is generated is reinvested into the business, either through delivering better products, delivering better outcomes, a better experience, and also lowering fees. So they've had a really strong track record in Australia and the US and really around the world of gradually lowering fees because they're not there to make a profit. Also, there's no conflict of interest either when building a product. It's really built for the end user, which is the owner, which is the investor, of course. Now, Vanguard's investment philosophy is founded very much on a rules-based, evidence-based approach, primarily market cap indexing. And I've spoken about sort of different indexing strategies. They do depart from that, but when they depart from market cap indexing, they really pointed out they actually call those funds active funds, and they're not really active funds. I wouldn't call them active funds. They're still using a low-cost rules-based approach, but they're very particular on, sticking to their core business. And their core business is to give investors access to particular stock indexes around the world and to replicate the performance of those indexes as closely as possible. And there's lots of things. They're a very large business. There's lots of things that they do in order to do that. Stock lending is one of them. A more efficient and effective sort of trading process. They've got trading desks all around the world, which means that their trading desk is open 24 hours because they're in different jurisdictions, of course. Australia's a key. Sydney trading desk is a key part of that, obviously being in the Southern Hemisphere. And that's something a lot of index fund providers can't compete with. It's all about squeezing the last little bit of value out of that index and minimizing any fee drag that occurs when, obviously a business needs to charge fees to recover those costs. Now, Vanguard has a long track record in Australia as well. So it's been in Australia since 1998. So, a very long period of time. We're coming on to almost 3 decades. So very much a long track record. Now, why am I talking about Vanguard Super? Well, until 2022, Vanguard actually managed a lot of money for industry super funds. So they would run index portfolios for industry super funds. In fact, they were managing around $20 billion. But in 2022, Vanguard decided, you know what, we're going to sack these industry super funds as clients and we're going to get into the super sector ourselves. So it's a pretty bold move to walk away from a pretty large portion of business and decide to, compete with that business. Now, every year I produce a podcast episode looking at the best returns for the financial year just gone, and also then having consideration naturally for longer term returns. Now, I normally do that end of July, early August, depending on when these results are published, and my work schedule, of course. And so I'll be doing that in a few weeks' time. And I've typically only compared the top 8 industry super funds. So I've excluded any retail funds out of that because typically over the last number of years, industry funds have really been the best place where that money should be in terms of highest return for the lowest cost. However, over the years, I've been really critical around the lack of cost control for industry super funds. So, their size has increased substantially over the last 10 years, but they've failed to sort of deliver at least to any significant margin on scale. The opaqueness of investments and management and the influence of political parties and unions. I want to keep this podcast apolitical, of course, but it's been well documented that unions and political parties, particularly Australian Labor Party, have deep tentacles inside industry super funds. So therefore, that's why Vanguard's entry into the super sector was so valuable. It's a welcome change because just like industry super funds, they advertise, we're for members, we're not here to make a profit, etc., which is all great as long as the management is sound, ethical and transparent, and as long as that not-for-profit motive actually results in lower fees for members, which, as I said, in a lot of the super funds it hasn't. All it's actually resulted in is higher fees for members, which is kind of ridiculous. So it's great to be a not-for-profit business, but only if you actually deliver better outcomes, of course. Whereas with Vanguard, it's got a long history of managing a lot of money, trillions of dollars around the world, and it's got a long history of delivering lower cost, and it uses an investment methodology that is incredibly transparent, rules-based and evidence-based approach. So it really solves all those problems or concerns that I have with respect to industry super fund. Now, the second reason I wanted to record this episode is because I will include in that comparison, in that end of financial year comparison, Vanguard Super. And I thought it was important then to, put some context, particularly as a relatively new product, put in context around, what Vanguard Super means, how good is it. And this will form part of my review. So if I decide that I think Vanguard Super relative to performance, like looking at investment performance, is a good option, then at least we're going to consider all the other factors that you should take into account when choosing a super fund, which is an incredibly important decision. There's two decisions, which fund and then what investment strategy, and both those decisions are critical. So anyway, as I said, I will publish that in the next few weeks. Now, one of the concerns with, and this is why I waited a little bit of time, one of the concerns is that it's a new product. As of April 25, Vanguard Super had about $2.8 billion of funds under management. Now, that's risen considerably from $1.4 billion in June 24, and Vanguard is growing 5 times faster than the rest of the super industry, but it's still a very, very small player. Last year I recommended or concluded that UniSuper was the best industry fund. That's got 150 billion. Remember Vanguard 2.8, so it's substantially larger. And the behemoth, AustralianSuper, which I think is kind of number 2 or equal first, $360 billion, right? So super is a scale business. It is really a business that we hope to build tremendous scale, because to run a portfolio or run some money that's 3 billion versus 30 billion. Of course, the 30 billion has more members and more member accounts and so forth, but just from the actual investment management perspective, there's more work, but not 10 times more work. And that's where we hopefully can benefit from scale as investors. Now, If a fund doesn't achieve scale fast enough, it's only going to do two things. It's going to wind up, it's going to close, in which case then you've got to shift your super somewhere else, or it needs to raise fees. And that's why I think scale is an important consideration. Now, as I said, Vanguard is a mutual business, but when they introduce a product, that product needs to pay for itself. So the fees charged for that product need to cover the cost associated with that product. And they're very particular about that. Otherwise, they will wind up funds because they don't want investors in other products subsidizing products that they aren't invested in, right? That's, I guess, one of the benefits of a for-profit business is that it can explore new products even if they're loss leaders, even if they lose money. But a Vanguard doesn't have very much appetite to do that. Having said that, looking at the most recent financial statements lodged with ASIC, is showing that it's already successfully covering its expenses given its current fee points or levels, even though it's only got sort of circa $3 billion in the fund. So that's really pleasing from that perspective. The other thing to think about with the new fund is administration and customer service. And there's been a lot of media over the last 6 months about, the industry super funds again doing very poorly in that space, taking far too long to pay death benefits, these sorts of things. Look, we've experienced it too. It was probably in the last 6 months, a industry super fund said, look, we're not going to answer any calls from financial advisors anymore because we're just too busy. Their response to being too busy, well, we're not going to help you. And, if you are a member and you expect your financial advisor to be able to call your super fund and ask questions, I think that's a reasonable expectation, right? Turning around and going, we're just too busy, we're not going to answer the phone anymore is a ridiculous outcome. So they definitely need to do better there. Vanguard has appointed a company called Grow Inc. to be its administrator. It's mostly a technology-led company, an Australian company. It was founded in 2017, so been around for a little bit of time, but not a huge amount of time. And thankfully, Grow Inc. hasn't been linked to any of the industry funds that were criticised by APRA, which is the regulator, or the media. So far, so good. Of course, Vanguard, if they did start experiencing problems, they could choose a different administrator, of course, but it's one of those things to really think about. The next thing I wanted to talk about was management skill and reputation, because one of the criticisms associated with industry super funds is that their boards consist of people that have very little financial services experience. And when you're managing a fund that is looking after 30 to 130, 360, whatever it is, billions of dollars, you hope that there's people on the board that kind of know what they're doing. Now, with industry super funds, by law, they must have an equal mix of employer representatives and member representatives. And some of those funds will also have independent directors, although there's no legal requirement for there to be independent directors, which is something I know the coalition tried to legislate but weren't successful in doing so. I definitely think there needs to be some sort of independent board members. And the reason for that is that the employer representatives and the member representatives can be often influenced significantly by unions. So the member representatives will typically be union officials, and the employer representatives can be heavily influenced by the union, of course, because the employer is working in a industry. So if you look at CBUS, construction industry, you've got employers, so construction companies. How much do you reckon they're influenced by the unions? And then you've got the member reps. So really, the argument could be made that they're really union run, these industry super funds, particularly given that there's not many independent directors. Some of these people can be, union bosses and so forth. So senior management positions, presidents of unions, these sorts of things. They might have a lot of experience in many different industries, perhaps, but they tend to not have very much financial services experience, which is, again, crazy. It's such a big sector. Now, these rules, these employer-sponsored funds, industry funds, where you've got to have equal representation, this law was written back in the early 90s. So it needs to change because the industry's changed a lot. In contrast, Vanguard Super, it's managed really well. It's got 6 directors. A lot of them are independent directors. It's chaired by Peggy O'Neill, who was the president at the Richmond Football Club. Well, let's not hold that against her. There's 3 non-executive directors, 2 ex-Vanguard employees, so a good depth of knowledge there, and then 2 independent non-exec directors, so 6 directors across the board. But they all have very significant financial services experience. And of course, they benefit from Vanguard Australia, its investment management experience, 670 staff in Vanguard Australia and more than 20,000 global staff. So if you compare the management and skill and reputation of the people looking after your money, as far as I'm concerned, it's chalk and cheese. Okay, so let's get into the nitty gritty now, talk about investments, fees, these sorts of things. So Vanguard offers 3 different investment options: life cycle, single sector, and diversified. And I'll talk about each of these. So life cycle is where you are allocated to a particular investment asset allocation based on your date of birth, your year of birth, I should say, not the actual date. It essentially means that if you're 47 or younger with Vanguard, you'll be in a high growth strategy, so 90% growth, 10% defensive. But once you're 48 and older, your defensive element increases and in fact becomes quite conservative. So by age 60, your allocation is 60% growth and 40% defensive, which for a 60-year-old is pretty conservative. The single sector option allows you to invest in single sub-asset classes, things like Australian shares, international shares, hedged and unhedged, fixed interest, and cash. And I don't recommend this option. Most people don't have the skill to be able to kind of build an asset allocation and manage that asset allocation over time. The third option is called diversified, and that's the one that you're going to be more familiar with. It's sort of like growth balance, conservative, these sorts of things like most other industry funds have. And I think a diversified option is the best because you can then pick which asset allocation you think best aligns with your position, your stage of life, your risk profile, all those sorts of things. Also, the diversified options have exposure to emerging markets and smaller companies where those exposures aren't available in a single sector option. The thing to know, though, with these diversified options, they tend to be relatively conservative, especially when you compare them to industry super funds. So its growth option has 30% allocated to defensive investments. Its balanced option has 50% allocated to defensive investments, which I think is just way too much. So don't worry so much about the options name. Really just look at how much is in growth and how much is in defensive and compare with other funds to really work out where you think you sit. Now, I've previously argued in this podcast that I think super investors should be mostly invested in growth. Now, that is true, particularly if you're in your 40s or younger. But even if you're in your 50s and even if you're in your 60s, I would argue maximizing long-term returns is the most important thing. And volatility is really just an education piece. If you're really worried about volatility, I would say don't and stop looking at your super balance. And that's probably the best approach to that issue rather than necessarily adjusting your asset allocation. If I said, oh, look, I promise to give you 8% every year, not every year, I should say, on average over a 10-year period, you'd be pretty happy with that. If I said, I'll give you 8% if you promise to never look at the balance, I think most people would still, yet again, conceptually, be happy to do that. And really, I think that's the approach. So having a look at those options then, high growth in Vanguard Super is a 90% allocation to growth assets. I think I would encourage most people to consider whether that high growth option is appropriate for their circumstances and whether they're comfortable with that. I think it would suit a lot of people. Now, the problem is that Vanguard was only established in the last couple of years. It's less than 2 years old, I think. Vanguard Super, that is. So it doesn't really have a long track record, something I'm going to need to deal with when I complete the analysis. I'll need to think about how I do that. But it's had a high growth index fund, which is a managed fund that's been in operation since 2002. November 2002, in fact, is when I established ProSolution. So it's got a more than 2-decade experience. I won't say it's going to be a perfect example of what the returns will be in the super product, but it's using the same funds. And, of course, the asset allocation has changed over time. And so that's the thing that could change in the future. And how that asset allocation change could impact future returns, no one really knows, right? But I think it's a really good indication of how this manager has changed asset allocation over time and delivered a high growth fund in terms of returns. But as I said, I'm going to get to returns in a couple of weeks' time. So I would just say sort of park that for now. Okay, let's talk about fees, because fees are certain, returns are uncertain. And so, particularly in an environment where returns are low, and returns have been pretty good over the last sort of 5 years inside super. So, fees start to become less material, but there will be periods of time where returns are negative or very low. And that's when, in particular, I mean, fees are always important. That's when they really become to the forefront. But I think people should be focused on fees at the beginning because, as I said, fees are certain. You're always going to pay them. Returns are uncertain. So Vanguard charges two fees, two administrative fees and one investment fee. So the first administrative fee is just what's called a general admin fee. So it charges 0.32% of your balance, capped at $300,000. So that's the balance capped, not the fee, of course. That means that the maximum general admin fee you'll pay is $840 a year. Now, this is really important point, particularly for people with higher balances, because that's where you get scale. So either fixed dollar fees or cap fees are really valuable because as your balance grows, the fee doesn't necessarily grow. I should mention that Vanguard had actually reduced that fee last year. So they've already had an example of passing on some fee reductions. The second fee that they charge is called, and the marketing department must have been up very late to come up with this name, Operational Risk Financial Requirement. So an ORFR fee of 0.05%. So a very small fee, charged monthly, and there's no cap on that fee. So they're the two admin fees. And then the investment fee for the high growth option is 0.21%. So again, when you are going to agree to have percentage-based fees, make sure they're as low as possible. You can't go absolutely lowest. Sometimes people go, I'm going to go to Host Plus Index Balance because it's tiny fee. I can't remember what it is, but it's very small. You've got to give consideration to returns as well, of course. Fees is what you pay, returns is what you receive, but minimizing those percentage fees are really critical. And I've completed a comparison. I've completed a comparison between Vanguard Super, AustralianSuper and UniSuper. And I've tried to compare the investment options, high growth investment options that align best or compare best with Vanguard. And so if you have a $300,000 balance, Vanguard is the lowest cost by about $400 a year. If you've got a $500,000 balance, Vanguard Super, again, lowest cost by about $1,000 a year. And if you've got $1 million in super, Vanguard Super is the lowest cost, of course, by around $2,500 a year. Pretty significant difference in fees, both in dollar terms and percentage terms. And the reason for that is the low ongoing percentage fees. For instance, UniSuper's investment fee is 0.71%. Remember, Vanguard is 0.21%, so another 0.5% they're charging, which isn't a big deal when your balance is $50, but becomes a huge deal if your balance is over $1 million, and that's when you need to be really thinking about those percentage-based fees. Now, insurance is another factor to think about when choosing a super fund, because a lot of people have insurance inside super, and particularly life and TPD. TPD is total and permanent disability insurances, and having those two insurance products inside super typically is the best way to go, because if you have those products, life and TPD, outside of super, typically the premium's not tax deductible. Whereas inside super, it is deductible, albeit just at a 15% rate. So not a huge tax benefit there, but at least some tax benefit. And if you receive those benefits and they go to a financial benefit, so if you pass away, get some life insurance, it's paid into super and then it's paid to a financial beneficiary, there's no tax on that payment. So it tends to be the most optimal way to do that. Vanguard Super uses AIA to provide that insurance, which is a reputable firm, of course. There's no maximum cover for life cover. The maximum for TPD cover is $3 million, as long as your life cover is at least $3 million as well. So I think that's more than enough probably for most people. They have income protection insurance as well. So the max cover there is $25,000 a month or 75% of your pre-disability income. So it's an indemnity policy there. Makes sense, but typically I like to have income protection outside of super. Regarding the quality of the cover, because, there's one thing, cost to cover, and then quality. Quality means that, if you come to claim, you're actually going to get a benefit. If you've got a very poor quality insurance product, there's no point paying a premium for it, even if it's cheap, because if you're never going to get a benefit when you make a claim, then kind of what's the point? So we use an industry rating software called IRES to review insurance products, and it actually rates higher than both AustralianSuper and UniSuper. So the product quality is pretty good. I also ran some insurance quotes to compare the cost of cover. UniSuper was quite high. AustralianSuper and Vanguard were very similar in terms of cost of cover. Now, it's important to know that, insurance quotes can be unpredictable. Like, you can run a quote for someone, you think, oh, I think it's going to be $2,000, and the cost comes back at $6,000. So even though you've run these quotes, many hundreds of times, they're still difficult to predict. So it could be different for different people. I didn't run a whole bunch of different quotes, but you just need to think about that. But looking at the structure and so forth, the insurance option within Vanguard Super, there's nothing that is an obvious concern at this stage, which is not to say it's going to suit everyone, but there's nothing obvious. It looks pretty good. Now, Vanguard is what's called a pooled super product, and that means they're less tax effective because essentially a unit price is struck at the end of the day, and included in that unit price is an allocation for a tax liability on any unrealized capital gains. And so essentially you're taxed on those gains every day. They're sort of withdrawn from your balance through a lower unit price. Whereas if you had a wrap platform or a self-managed super fund, that doesn't happen. So any unrealized gains, as long as you're below the transfer balance cap, which is $2 million per person after 1 July, if you have any unrealized gains when you transfer from accumulation to pension, so when you retire, those unrealized gains disappear. So therefore, if you started a self-managed super fund when you're 25, made an investment into a Vanguard diversified fund, held that fund for, until you're 60, 35 years, you've made some gains. Hopefully you've made some substantial capital gains, and you're in a self-managed super fund, you transfer, you're below $2 million in terms of balance, those capital gains disappear. So really good, particularly if you're young and you're going to commit to a particular kind of way of investing in your super, and there's strong value in doing that. Vanguard's not going to be the fund that's going to allow you to do that. Now, how much tax are you going to save, or what difference does that make? Look, it's really difficult to estimate because it depends on things like your balance, how quickly your balance grows, your investment risk, mix, I should say, difference between income and capital, the portfolio turnover. So, do you change these investments? Are you forced to change these investments at some stage for some reason? Your age, all these sorts of things. Look, I plan to do some more work on this, and I'm going to have a look at some clients. I think that's probably the best way to look at it. Just choose randomly a bunch of clients and see what impact that would have on their balance in terms of avoiding these gains. But if I just look at the portion of my wife and my self-managed super fund, for example, and just I've got some other assets, property and some unlisted assets and so forth. But if I just look at the share portfolio that's on the wrap platform, about 1/3 of the balance is unrealized gains. And we've made some significant contributions in the last 5 years. So it's only been, a lot of that money was only invested more recently. So over the next 10 years, I expect that to grow significantly. It's probably going to be more than half of the balance, hopefully even more than that. So, depending on circumstances, that tax saving could be considerable. I'm going to do more work on that, so we'll just park that for now. Finally, the user experience. So how does it all work? So you can log on online or use their iOS or Android app. They've got that to manage your super, which you can look at the balance, of course, any transactions, change investment options, upload documents like notice of intent to claim, download statements, manage your insurances and beneficiaries, all those sorts of things. So looks like I haven't used the app, I haven't used the online platform yet, but it looks like they offer all the same functionality that you would expect. So as I said, I'm going to do a deep dive on super returns for the 25 financial year in a few weeks' time. I'm going to include Vanguard Super in that analysis. So far, so good. Everything I've seen so far and assessed so far, it looks like a really good product and a really good option, and potentially a better option than industry super funds. But let's wait for a few weeks. Let's look at those more recent returns and then have a think about those longer term returns as well, because that's the final sort of piece in the puzzle to work out which is the best super fund. But hopefully that's been useful. As I said, I don't normally just talk about single products. I don't normally want to do that. I don't want to seem like I'm employed by Vanguard or anything like that. Of course, I'm not. But hopefully that's useful and is a good sort of precursor to the episode that I'll be publishing soon. Okay, run over time today. Apologies for that. Until next week. Bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.